Welcome back, friends. So you have now learned how to spend and save your money. But all that spending and saving discipline is of little use if you don't know how to protect your money. Now, what do you mean by protecting your money? Life is uncertain and not everything is in our control. While we may adopt a healthy lifestyle which may swing the odds in our favor, it's still not possible to completely avoid any serious illnesses. And what is more concerning is that spending even a couple of weeks in the hospital can give you a bill that's equal to several months of your salary. This can possibly set you back financially and put you into debt. This is the reason why we feel that health insurance is so critical. In fact, health insurance is one of the first purchases that you should be making with your money. In health insurance, you pay a sum of money called premium to the health insurance companies annually. In return, the insurance company, subject to certain terms and conditions, covers your hospital bill up to a certain amount called the health cover. This is how health insurance works in short. Now, while getting health insurance is relatively straightforward, it is important not to get tricked by insurance companies. They often use confusing terms and try to sell you a bad deal that may look like a good deal. So here are some of the things to consider before going for health insurance. Number 1, don't opt for copay. Copay simply means splitting your bill with the insurance company. If the insurance has a copay clause of 20% and you have a hospital bill of say 5 lakhs, that means you will have to contribute 1 lakh towards that hospital bill. The insurance companies charge you a slightly lower premium to include this copay clause, and this is one of their ways of tricking you. Number 2, don't choose an insurance with a room cap. You should have the freedom to choose a private room or an AC room. Some insurance clauses stop you from doing so. So make sure you don't have such clauses in your insurance plan, and you should have the liberty to choose a room which is comfortable to you. Number 3, make sure that the waiting period is short. When you buy an insurance, there are certain diseases that are not covered in the initial years. These are typically diseases like blood pressure and diabetes. This is because the insurance company wants to protect themselves from folks who may buy the insurance after they have been diagnosed with these diseases. Number 4, make sure that there are no disease level limits. Some insurance companies put a cap on the cover for a certain type of a disease. For example, even if your health cover is 5 lakh, an insurance company may choose to put a cap of say 2 lakh on a certain type of disease. Never opt for such an insurance plan, as your effective coverage would be much lower than the coverage for what you are paying the premiums for. Number 5, how much should your health cover be? If you're in your 20s, an ideal health cover would be 5 lakh. We encourage that if you can spend a bit more, you can take it up to 10 lakhs. You can always modify your cover amount in your lifetime, but the premiums charged will also modify accordingly. And number 6, and most important, don't lie to the insurance company. Insurance companies do not want to pay your hospital bills, and thus they will desperately try to find a loophole so that they can avoid doing so. If you lie to your insurance company at any stage and they find it out, they have a right to reject your claim. So never lie to them, and always keep them updated if there is a major change in your health condition. Now, health insurance is for your financial safety in case of any illness. But what if that illness results in your death? Now, we all have a family to take care of. You may not have a family to take care of now, but as you get older, your responsibilities towards existing and new members of your family will only increase. And thus, life insurance helps to take care of your family's financial safety in case of your death. Now, the concept of life insurance is similar to that of health insurance. You pay premiums to the insurance company, and the insurance company in return promises to pay a cover amount to your family in case of your death. However, there are 2 major differences between life insurance and health insurance. Number 1, life insurance benefits are up to a certain age, which you fix at the time of buying the insurance. In health insurance, on the other hand, the tenure is for 1 year. It is up to you whether you want to renew it after that or not. And number 2, life insurance premiums are constant throughout the term. In health insurance though, the company increases the premium from time to time to account for inflation in the healthcare sector. While there are many aspects of life insurance that you need to know, the most critical one is to understand the difference between a pure term plan and a guaranteed benefits plan. In a pure term plan, you pay premiums till you attain a certain age. And if you're alive at that age, your premiums are gone. However, if your death occurs before that age, then the insurance company pays the cover amount to your family. However, things work a bit differently in a guaranteed benefits plan. Your family still gets the cover amount from the insurance company in case of your death. But in this case, if you survive till that age, you get your premiums back with a certain amount of interest. Now, armed with this piece of information, you may feel that a guaranteed benefits plan is way more beneficial than a pure term plan. You get something no matter what. But guess what? In a guaranteed benefits plan, the premiums that you pay are 3 or 4 times higher than what you pay for a pure term plan. Moreover, the interest rates that you get in a guaranteed benefits plan is much lower than even the rate of inflation. So mathematically, buying a pure term plan makes much more sense. And the difference in premium that you save can be invested into mutual funds. Over a long term, this combination makes much more sense than a guaranteed benefits plan. Now the next question, and a rather important one, is how much should be your ideal life cover? Now this is a very tricky question and can be looked at from various angles. But the best way to look at it is that the insurance cover should be a financial substitute for the income for your family. Simply put, the insurance cover should be able to replace the income that you used to provide for your family. Now this makes it trickier because the income that you were getting was a regular stream like a monthly salary. But the insurance company pays your family a one-time lump sum amount in case of your death. So it becomes a bit tricky as to how to invest this one-time amount so as to create a regular income stream like a pension for your family. But we have you covered. You need to determine only 3 things to estimate a sufficient cover amount. Number 1, your monthly contribution to your household expenses plus any EMIs. Number 2, your retirement age. We can assume it to be 60 years. And number 3, the inflation rate. We can assume that to be 6%. Now simply put these 3 values in the calculator by visiting the link in the description box and you're done. Alright, so health insurance covers your family against hospital bills. Life insurance covers your family in case of your death. But there is another important insurance that is not talked about. Insurance against unemployment. During bad times, even the most talented folks get laid off. And if you have been following the news recently, a lot of startups have laid off employees. However, you can insure yourself against this unemployment by creating an emergency fund. An emergency fund is simply a few months of your expenses saved away in a safe instrument like a fixed deposit. This is amongst the first things you should be doing as soon as you start earning. Now, a commonly asked question is, what should be the size of your emergency fund? We ideally feel it should be no more than 6 months of your expenses. But again, use your judgment. As we said, we can provide you with the thumb rules and the frameworks, but it is you who is going to customize your own personal finance journey. So that's the end of this video, folks. To sum up, insurance is critical. You must not skip it, and definitely not be tricked by insurance companies. And although life and health insurance is important, you must also insure yourself against unemployment by creating an emergency fund. That's it for this one, folks. See you in the next one.